Good morning, everybody. It's Monday, July 22nd, 5:25 a.m. Central Time. Grain markets are higher this morning. Nice change of pace. December corn futures up 7 at 411 and 3/4. November soybeans up 19.5 at 1055.5. December Chicago wheat up 4.5 at 572.5. December Kansas City wheat up 2 at 588 and 3/4. December spring wheat up 8 3/4 at 638 1/4. Let's start off with weather.
Following what is expected to be another 5 days of cooler temperatures, heat is slated to return to the U.S. Corn Belt this weekend. Temperatures are then expected to run above normal through the 15-day period. The precipitation forecast for the next 10 days is largely dry. This morning's Euro model offers almost no rain for the entire region this week. The 5 to 10 day forecast offers some limited rain for parts of Iowa and Minnesota, leaving the majority of U.S. corn and soybean areas dry. The extended GFS offers rainfall for the eastern Corn Belt during the first week of August, but still leaves much of the West dry.
I believe we've got a little bit of a weather rally on our hands here this morning. I say that because soybeans are leading the way, and that would make sense given the time of year. If you run into hot and dry weather, late July, early August, given the idea, of course, that the bean crop is made during the month of August, that would be friendly to market. One other thing I would note here is look at U.S. spring wheat country and look at the Canadian prairies, which are Canadian spring wheat areas. Hot and dry, hot and dry, hot and dry. Once you get out past this first 4 or 5 days here, there has been some concern that the weather forecasters and weather people have exhibited with regard to Canada in particular in those spring wheat areas. And if you look at spring wheat, it's leading the way with regard to the wheat complex this morning and did that same thing last week. So, yeah, I mean, this is not the normal time of year for a U.S. weather event. And this is not, I mean, yeah, 20 cents in beans looks good this morning, but you look at the charts and it's really not much. Could it turn into something bigger? Yeah, I suppose that it could. We've got a massive fund short in the market. Let's get to that piece of this.
So, fund traders continue to hold a massive net short position in the corn market. CFTC released weekly commitment of traders data on Friday. During the week ending July 16th, the funds were net buyers of 4,000 contracts of corn. The net short of 353,000 contracts of corn is the second largest on record, behind last week's all-time high. Funds were net sellers of 20,000 contracts of soybeans. The net short of 183,000 contracts of soybeans is the largest on record. Funds were also net sellers of 4,000 contracts of SRW wheat on the week.
So essentially, funds record short the row crop markets, record short corn with the exception of last week. We'll call it a record short in the soybean market. The question that we seek to answer this week is, will that weather forecast paired with maybe some of the slightly improved demand stuff that we've seen? We saw a big flash sale in soybeans last week. Is that enough to convince some of these fund traders who are heavily short to cover their positions? And if that happens, what sort of farmer selling enters the market on any rally attempt? Even a rally attempt this morning, is the farmer going to come in 2 hours from now and just sell the hell out of this thing because they've got too many old crop bushels floating around? That's a question mark. Here is a chart of corn, soybeans, SRW, wheat combined. The net short across those three contracts or three commodities, 609,000 contracts as of last Tuesday, which is a record and by a pretty wide margin. When you zoom in on just soybeans, we've got a brand new record fund short, 183,000. So if the trade or funds or whoever, if they believe the U.S. soybean crop is really at risk to a significant degree, then yeah, they may want to get out of some of this stuff. Absolutely.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about some of our premium videos from last week?
Jim Urio was on Thursday, and we talked a lot about Trump's. So it looks more likely that Trump's going to be the next president. That's the way that it looks. We saw Biden dropped out yesterday. But in any case, what are some of the markets that are moving based on this idea that you're going to see a Trump presidency? We talked about that, a lot of political stuff. On Friday, I did a mini mailbag grain marketing type thing. One of the questions that I've seen come across my desk more often than I've probably ever seen it during the last 2 weeks is this question: should I sell right now? And everybody is interested in selling when the market's low. When the market's high, I never get this question. And I talked about some of the mentality behind this. We also did some stuff with cash grain marketing and basis, that sort of deal. If you guys want to see the premium stuff, brand new videos every single business day. You'll get our morning email every day at 5 a.m. Central Time. Pete Meyer's is going to be on today. We're going to talk biofuels, grain markets, marketing. I think tomorrow I'm going to have a full grain marketing review where I run through cash grain sales, everything I've advised, kind of what the game plan is moving forward. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. What we do here on the podcast and YouTube, this is a news show, guys. What we do in the premium stuff is actionable analysis, grain marketing, crop insurance, policy, all that stuff, information you can actually use to improve your business. Check that deal out this morning. Sign up. I'll forward you a copy of this morning's email, which includes the 6 most recent premium videos, along with a whole bunch of other stuff.
Agricultural groups are requesting that domestic feedstocks be required in the 45Z guidelines. Last week, the groups sent a letter to the U.S. Treasury Secretary urging that feedstocks be produced domestically in order to qualify for the 45Z tax credit. The requirement would benefit U.S. farmers, obviously, and it would also increase the environmental benefits of the 45Z tax credit by providing a feedstock with a lower carbon score, according to the groups. Additionally, the letter stated that many farmers are unable to implement the climate-smart ag methods outlined in the SAF guidance. Those included in the letter are the National Farmers Union, the American Farm Bureau Federation, the National Corn Growers Association, and the American Soybean Association.
Washington is in a state of chaos right now, I think. We don't know exactly what's going on behind closed doors. So Biden dropped out, but he's still going to run the country till January, I guess. Are they going to make any decisions with regard to this before then? I really don't know. This was a well-worded letter. They should be writing letters like this every single day because the holdup on this guidance is absurd. It should have been out months ago. I'm going to read a couple pieces here. While we appreciate your administration's commitment to sustainable energy and reducing greenhouse gas emissions, the current framework of the SAF guidance poses significant challenges for producers, and we believe that it is unworkable in its present form. They went on to say, the 45Z tax credit has the potential to be a game changer for our industry, offering a valuable incentive for the production and use of biofuels that will lower carbon emissions. However, without clear domestic feedstock requirements, the benefits of this policy are at risk of being diverted from American farmers. And they're not at risk. They're already being diverted from American farmers with the import of used cooking oil. They went on to say this is the last thing I'll read. Currently, the guidance does not mandate the use of domestically sourced feedstocks for eligibility, opening the door for imported materials to be used in biofuel production. This not only undermines the economic stability of American farmers, but also contradicts the broader goal of supporting U.S. agricultural and rural communities. So they actually mentioned mandate here. The guidance does not mandate the use of domestically sourced feedstocks. And if they were to do such a mandate, that would be a big time positive for demand. And we could really, really use that.
USDA reported a flash sale of soybean cake and meal on Friday. U.S. exporters sold 105,000 metric tons. I have a typo on that graphic right there. I believe it's 105,000 metric tons of soybean cake and meal to unknown destinations for delivery during the 24-25 marketing year. On Thursday, an identical sale was made. The combined sales totaled 210,000 metric tons total.
We have some evidence of improved demand. So you got this. We had that larger soybean flash sale that was Wednesday or Thursday last week to an unknown. There was the story we ran last week about some of the Asian buyers coming in for wheat and buying more of it. So lower prices should generate additional demand. And maybe that's finally what we're starting to see here.
We did have a cattle on feed report come out on Friday. Cattle on feed as of July 1st were reported at 101% of year-ago levels, which was in line with the pre-report trade estimate. Placements in June were reported at 93% of year-ago levels, lower than the pre-report trade estimate of 97%. Marketings last month came in at 91% of year-ago levels, slightly lower than expectations. The report is considered neutral to slightly friendly as the cattle on feed number came in as expected and placements were lower than anticipated.
Looks strongly neutral to me. What did cattle prices do last week?
So feeders were down on the week. On Friday, they were down 52 cents to $1.30 lower. Live cattle were 85 cents higher to 52 cents lower on Friday. On the week, they were slightly higher. Cash cattle trade was lower last week. And then in the north, cattle sold at $196, which was $2 lower from the previous week. In the south, cattle traded at $187 to $188, which was about $1 lower compared to the prior week. Box beef lost significant ground last week. Choice closed Friday at $313.83. That was down $8.23, and Select closed Friday at $298.80. That was down $351 for the week.
Outside markets to start the week. U.S. dollars off just a little bit. Stocks are up. The S&P's up 25. The Dow Jones up about 50. Bonds are up just a little bit. Gold and silver are mixed. Crude oil is down 25 cents in the September WTI at 78.39. Have a great week, guys. We'll talk to you Tuesday.